Crypto arbitrage trading involves exploiting price differences for the same cryptocurrency across various exchanges or markets. Here's a step-by-step explanation. 1. Price discrepancy identification. Monitor multiple exchanges and identify a significant price difference for the same cryptocurrency. 2. Buy low, buy the cryptocurrency at the lower price on one exchange. 3. Sell high, immediately sell the cryptocurrency at the higher price on another exchange. 4. Profit. The difference between the buy and sell prices is the profit. Types of arbitrage. 1. Simple arbitrage, buying and selling on two different exchanges. 2. Triangular arbitrage, exploiting price differences between three currencies on the same exchange. Tools and strategy. 1. Arbitrage bots, automated software that identifies and executes arbitrage opportunities. 2. API integration, connecting to exchange APIs for real-time data and faster execution. 3. Risk management, setting stop-loss orders and limiting position sizes to minimize losses. Challenges and risks. 1. Exchange fees. Fees can eat into profits. 2. Price volatility. Rapid price changes can result in losses. 3. Liquidity issues. Insufficient liquidity can make it difficult to execute trades. 4. Regulatory risks. Changes in regulations can impact arbitrage opportunities. Best practices. 1. Stay informed, monitor market news and exchange updates. 2. Diversify spread investments across multiple exchanges and cryptocurrencies. 3. Set clear goals. Define profit targets and risk tolerance. 4. Continuously learn, improve strategies, and adapt to market changes. Tools and strategies. 1. Arbitrage bots, automated software that identifies and executes arbitrage opportunities. 2. API integration, direct connectivity to exchange APIs for faster trading. 3. Risk management strategies to minimize losses, such as stop-loss orders. 4. Market analysis, monitoring market trends and news to anticipate price movements.